Welcome to Illuminati Silver's Inner Sanctum, where we tell you the truth about precious metals, economics, politics, and business. Today is Wednesday, the 2nd of October 2019, and we're going to attempt to explain, hopefully in simple terms, as to how the repo market works. Now, we produced a video on this subject for general release a little over a week ago, and we put a link in the description box below in case you haven't had the opportunity of listening to it. But much has been made recently that the Federal Reserve has found itself in the position of getting involved in introducing hundreds of billions of dollars into the financial system as the repo market was short of funds. Now, the repo market is vital in how Wall Street and the financial system works, and is a major conduit through which investors, big and small, usually big, receive short-term money to fund operations. The lenders of securities in the repo market are often hedge funds and Wall Street broker-dealers that have large portfolios, or investment banks, but need money to fund their day-to-day trading. The cash providers tend to be money market funds or commercial banks or other asset managers that want a place to invest their cash on a short-term basis with little risk. So banks, hedge funds and other major financial players borrow money on a short-term basis to ensure their books are in order. Often these monies are borrowed overnight or one day, or occasionally for a week, but relatively short time periods, so as to ensure that those businesses and funds do not experience liquidity problems. So let's just take a look at how this system works. We show it on the screen. Okay, this is the process. Bank A sells $100 million worth of bonds for overnight cash. Bank B gives the cash to Bank A and holds onto the bonds. The next day or the next week, depending upon when the deal and for how long the deal is struck, Bank A gives Bank B the £100 million or dollars cash back plus interest, which is usually 2% per annum. Bank B then returns the bonds to Bank A, and both banks are happy. But what if there is no cash or insufficient cash available? Well, usually there is. However, if there is a shortage, a higher rate may be charged, which then encourages the lending banks to make resources available. But if that does not happen, then the Fed intervenes and makes up the shortfall. Now, what if the Fed has no cash? Well, that's highly unlikely, as it has more cash than banks usually wish to borrow, and if necessary it can print it, though that does have its problems and consequences later on. What if Bank A, that wants cash, runs out of treasuries as collateral? Because normally they issue treasuries because they're safe, guaranteed and very liquid. Well, it can use other securities, providing another bank is willing to purchase them, such as government guaranteed agency debt, mortgage-backed securities, corporate bonds and equity. But each one, of course, as you go down the list, and there are more, becomes less and less secure. One of the problems experienced with Bear Stearns and Lehman Brothers during the 2008 crash was that the bonds they were issuing were mortgage-backed securities, and we know what happened there. So why did the Fed actually intervene recently? Well, there are 5 main reasons. One of them we've added. The Fed hasn't admitted to it, but it's what we have basically deduced, and we think we're quite accurate in it. First of all, liquidity was removed from the system due to quarterly tax payments being due. So these institutions had to make their tax payments, and as most of them make money, they have tax to pay. So that removed liquidity and therefore the demand for cash. Liquidity was also removed from the system due to the settlement of treasury auctions. Obviously, people had purchased treasury bills, they now had to pay for them. This third point is ours, bad planning by the system administrators. We actually genuinely believe that an error occurred because, having known the first two were likely to occur because of the timing, they made quite a mistake in underestimating how much liquidity would be necessary. The fourth point, which has only come about recently, is the change in JP Morgan's balance sheet restricted its ability to lend. Now, JP Morgan is one of the major players in the repo market and often has money it can lend cash. Unfortunately, because of certain asset changes and, point 5, regulatory constraints on banks, it actually limited the amount of cash it had available to lend, which helped to create the shortage. And therefore we saw rates rise as high as 10% at one point, but generally then fall back to around 5%, when the normal rate is at or around the Fed funds rate of between 1.75 and 2%. What are the after effects? Well, the Fed has agreed to inject $75 billion a day until October the 10th. By then, the market should return back to normal. Now, if it doesn't, and there's no guarantee that it will, then additional support will be required. That might be a further lending of a similar amount, or, as we suggest and predict, that the Fed will ease some of the restrictions it has placed on the other banks, thereby releasing their liquidity further. But we shall have to wait and see. Is it an international crisis? Is it an economic collapse? We believe not, as this is a perfectly manageable financial situation. Not a pleasant one, not a preferred one, but a manageable one. Now, of course, if we foresee or identify that more than 75 billion a day is required to be injected, and this figure rises dramatically, then naturally one should be concerned. But at the present moment, there has been a blip or a glitch or an error which should, through the normal market mechanism and maybe a slight alteration of policy directives, correct itself soon. Now, we hope that that explains, albeit in simple terms, the situation and how the repo market works. Generally speaking, somewhere in the region of 80% of the assets exchanged in this way are US Treasuries, certainly as far as the US repo market is concerned. The rest is then made up of those other items that we have mentioned. Now, of course, we would become more concerned if this asset backing suddenly slid down that what we call security level to tiers 2, 3, and 4, which then does suggest that there is an underlying systemic problem. And perhaps more important, a bank security problem. But until that happens, and we shall be watching this very closely, we are still relatively comfortable that the financial system, though on times is stretched, is in reasonable shape to deal with the daily demands for cash, both in and out. Thank you for listening. Do share your thoughts. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.